In this section, we will cover many types of different indicators. These indicators, combined with the patterns from the charts and from the candlesticks, will give any trader a much better edge on the market. The Parabolic SAR. SAR stands for Stop and Reverse, is an indicator used in strong trending markets to indicate buy and sell signals. It works by plotting dots above and below the price in order to determine the buy and sell signals. In this chart pattern, you can see how the Parabolic SAR moves with the trend. At the point of consolidation, notice that the dots move to the top of the candles. Once the period of consolidation comes to an end, notice that the trend continues and the dots go below the candlesticks once again. You may hear the Parabolic SAR indicator referred to as the stop and reversal system. The average directional index, or ADX, is used to determine when prices are trending in a strong direction. In many cases, some traders may call it the ultimate trend indicator. But keep in mind, the ADX can only help us gauge the intensity of the trend. We need to combine it with another indicator in order to provide good entry signals. The ADX consists of three lines. One is a moving average, which is the blue line, and two directional indicators, which is a red and a green line. Whenever the green indicator is on top of the red, this indicates a bullish movement. When the red is on top of the green, this indicates a bearish movement. While the moving average is a good indicator of the volume of movement in any direction. In this picture, notice we have a slight bullish movement. The bullish movement occurs when the green line crosses the red and we have the moving average trending in an upper direction towards the 75 mark. With the range market beginning and a buildup occurring, we see that the moving average moves closer to the 20 mark and the red and green line move closer together. Another very popular indicator are the Bollinger Bands. They were developed by John Bollinger in the 1980s, and it's very well known and often used on the market. There are three bands which consist of a middle band, which is a moving average, and the two outside bands act as standard deviations. The easiest way to understand how to use Bollinger Bands or how to recognize a trend or a movement is that when the outside bands contract and are close together, we normally are in a range market. And when the bands start to widen, you can expect extreme volatility. Now let's take a look at how to understand possibly what direction these will move. When taking a closer look at the image, we can see that we start off in a big bullish rally. In order to understand why this happened with the Bollinger Bands, let's take a look at point number 1. At point number 1, you can see that the candles are in the lower half of the Bollinger Band section. Once we have a rally that moves past the moving average and starts trending up to the top band, we see a widening of the bands and we notice that the candlesticks stay in the upper half on this particular trend. You can see after the bull rally, we get a period of consolidation. The bands tighten and we go into a range market. Keep in mind that once the bands hit a lower or upper band, they normally try to stay inside the bands themselves. Take a look at point number 2. When the candlesticks break below the lower Bollinger Band, they tend to retrace back up. In ideal, it stays in between the lower half, between the moving average and the lower band. Then at point number 3, we have the same reoccurrence where the bands break through with a strong bull rally through the moving average and continue a strong uptrend after. Here's a closer look at the Bollinger Bands in a trending market. Notice that when the bands hit the upper band and the outer band, they tend to retrace back towards the middle. Keep in mind, as long as they do not cross the moving average, the middle band, the direction continues. You can see at the top of this trend, once the Bollinger Bands break through the moving average, we tend to see a reversal in the pattern, and likely into a range market. Here we have the envelope indicator with two moving averages. This is the most common example of an envelope, which is created using two moving averages that define upper and lower price range levels. Traders look for price reversal indications whenever the candlesticks break through both moving averages. Take notice that during this trend, we remain in a bearish momentum while the candlesticks do not break the two moving averages. Once we get into a range market, we can see a few attempts for the candles to break through the moving averages. During this range market, the moving averages lay flat. Once we see a breakthrough on the bottom half, we see a small bearish run. Then we go back to a range market with a couple of false breakouts. Here we will look at the Ichimoku Cloud, also known as the Ichimoku Kinko Hyo. Since this indicator is a bit more detailed, we will break it down into its three essential parts. The Ichimoku Kinko Hyo defines support and resistance, identifies trend direction, gauges momentum, and provides trading signals. The first set of this indicator that we will break down will be the Kijun line and the Tenkan-sen line. These are used to provide trading signals once they cross one another. As you can see at the top of this chart, once the red line crosses the blue line, we have a trend reversal. The Chikou span line, indicated by the green line on this chart, is plotted for the last 26 periods on the candlestick chart. This is used mainly to identify potential trend changes. Notice that while there is a bullish run, the Chikou span line remains on top of the candles. Once we see a downward tilt on the Chikou span line and it crosses, we see that afterwards the candlesticks drop as well. The last set we'll take a look at are Senkou span A and B. These form the cloud. The cloud serves as a dynamic support or resistance during a trend. Cloud, Kumo in Japanese, the cloud provides support and resistance levels, and this is done 26 periods into the future and helps provide information on where support and resistance may form next. Now that we know what all 5 components of the Ichimoku Cloud look like separately, this chart doesn't look so much like a plate of spaghetti. This indicator may take a lot of practice to get familiar with, but once mastered, it comes in handy more times than none on the market. The moving average is an easy-to-use indicator that smooths out price action. It's suggested to use with other indicators because this indicates the trend by simply implying that when the candlesticks are below the moving average, the market is in a bearish state, and when above, it's in a bullish market. But this alone isn't quite enough to get a good read. In this chart, you can see that the trend reversal occurs from a bearish to a bullish. During the bearish movement, the moving average sits on top of the candles, and you can notice that there are several times where the candles attempt to break the moving average with false breakouts. We see that the bullish trend starts, and along the way the candles test many times to break the moving average without success until the end. The exponential moving average, or EMA indicator, was developed to counter the lagging weakness of the simple moving average. It does this by weighing more recent prices heavily. In this chart, you can see that the EMA, which is the light blue, is above the moving average, which is the yellow. There is generally a bullish trend during this time, and below the moving average, it's a bearish trend. As you can see, the EMA and SMA combined together give a more clear directional path for where the candlesticks may head next. In this chart, we can see where the EMA crosses the moving average line, and the blue essentially goes on top of the candles and on top of the moving average. During this time, we have a strong bullish rally. You can see during periods of consolidation, these two indicators together are not very useful. The blue and the yellow cross multiple times. Another fairly simple indicator to use is the standard deviation. Standard deviation is basically a way to chart volatility, especially during a trend. When the standard deviation line is close to zero, there is nearly no volatility during that time period. However, when the standard deviation rises, so does the price action movement. On this chart, notice we start off with a bullish run. The standard deviation rises well above the zero line. Then we have a trend reversal, and we start a bearish run, and you can see that the standard deviation moves down towards the zero line. Note that the standard deviation does not give us an indication of what direction the price will move, just when volatility occurs. The donchian channel is very similar to the Bollinger Bands, as it helps stay in the trend and find good entry and exit points. This indicator consists of 3 bands. The basic setting for the donchian channel is for 20 periods, meaning that the outer 2 bands are the 20 period high and 20 period low. On this chart, you can see 2 crossover sections and a trend reversal that follows. The first trend reversal goes from a bearish to a bullish market. During this trend reversal, notice that the candlesticks break through the middle band and continue on an upward trend until the second crossover. During this stage, the candlesticks cross over the middle line again and reverses into a bearish market. Hey guys, it's David. So you've just finished the first section of our indicators part of the book. These were the trend indicators. Next, you will be looking at volume indicators. Feel free to pause the book anytime and take a breather. There's a lot of information. If you guys have any question, of course, go to our website, sign up for a free consultation, and speak to one of our professionals. We will help you get started and help you gain a lot of knowledge.